Let's slow this down for a moment, because when markets speed up, most people instinctively rush their thinking. And that's usually when mistakes happen. Silver isn't just rising, it's behaving differently. And behavior matters more than price when you're trying to understand what comes next. A lot of people are staring at the number on the screen, asking whether it's too high, whether it makes sense, or whether it can keep going. Those questions feel logical, but they miss the bigger point. Markets don't change character because a price looks expensive. They change character because pressure has been building quietly for a long time. What we're seeing now is that pressure being released. We're entering a very sensitive window for markets. There's important policy communication ahead, and the details matter less than the tone. The market is tense, and tense markets don't wait for certainty. They move first and explain later. That's why this moment feels different. Silver isn't responding to a single headline or a single data point. It's responding to a broader shift in confidence, liquidity, and expectations. When those forces move together, price can travel much faster than people are prepared for. For years, silver lived under low expectations. Even optimistic outlooks were conservative. It was treated as an asset that always promised more than it delivered. That reputation didn't disappear overnight. It broke because reality forced it to. When an asset rises strongly over time, and then accelerates even more in a short window, you're no longer watching a slow reassessment. You're watching urgency take over. Capital isn't waiting anymore, it's repositioning. And urgency almost never comes from optimism alone. One of the biggest forces behind this move is the currency backdrop. When the currency used to price everything starts weakening, it doesn't just change numbers on a screen, it changes incentives. For global buyers, purchasing power increases. For domestic investors, long-term value starts to feel less certain. That combination is powerful. As the dollar softens, commodities priced in dollars naturally attract demand from outside the United States. That's mechanical. But the psychological impact is just as important. A weakening currency makes tangible assets feel less like trades and more like protection. Once that mindset takes hold, it feeds on itself. More buyers step in. Prices rise. Attention follows. Momentum builds. And once momentum builds, leverage is never far behind. This is where markets stop behaving politely. Another layer to this story is policy uncertainty. Markets don't need action to react. Possibility alone is often enough. When participants sense that central banks are constrained or under pressure, behavior shifts. Professionals don't wait for official confirmation. They reduce exposure early. They adjust positioning before the crowd notices. As that happens, liquidity thins. Thin liquidity is what allows prices to jump or drop quickly, without obvious news. It's not randomness, it's structure. When there aren't enough willing buyers or sellers at certain levels, price moves until it finds them. Silver, being a smaller market, feels this effect more intensely. That's why you see sharp moves that don't seem to line up with headlines. It's not chaos, it's the absence of depth. Geopolitical uncertainty adds another layer. Trade tensions, tariff threats, shifting alliances. None of these need to resolve to influence markets. Persistent uncertainty alone drives defensive behavior. This is where precious metals come back into focus. Gold usually responds first because it absorbs institutional capital quietly. It reflects long-term concerns without drama. Silver responds differently. Silver is smaller, more sensitive, more reactive. When capital flows into silver, it doesn't arrive slowly, it rushes. That speed creates opportunity, but it also creates violent pullbacks. This is where people get hurt. Many investors confuse volatility with danger. Volatility is just movement. The real danger is fragility. Silver's fundamentals amplify this environment. Unlike purely financial assets, silver is deeply embedded in the real economy. It's used in electronics, energy systems, and modern infrastructure. These uses are structural, not optional. At the same time, supply doesn't respond quickly. Much of silver production depends on mining decisions made years ago. When demand accelerates, supply can't immediately follow. That's why price doesn't move smoothly. It jumps. But let's be honest. Not all of this move is driven by fundamentals. Speculation plays a role, especially in a relatively small market. Speculative flows increase speed and exaggerate swings. That doesn't invalidate the broader picture. It changes how the journey unfolds. Speculation amplifies gains, but it also amplifies shakeouts. And shakeouts are where people lose money while still being right about the long-term direction. This is the most important idea to understand. This is not a market where being right is enough. This is a market where structure determines survival. You can believe silver is supported by currency dynamics and confidence shifts, and still lose money if your position can't withstand volatility. The market doesn't care about your thesis. It only cares about whether you're forced to act. Forced action is how wealth transfers from impatient hands to prepared ones. That's why the most important question right now isn't how high silver can go. The real question is whether your positioning allows you to stay calm when the market moves aggressively. Strong markets don't reward agreement. They reward discipline. And discipline only gets tested when volatility spikes and emotions get involved. Silver is especially good at exposing weak discipline. When prices rise quickly, confidence builds fast. People stop thinking about risk and start thinking about upside. That shift is subtle, but dangerous. Fragility shows up when positions require calm conditions to survive, when leverage is used casually, when decisions are made reactively instead of deliberately. Silver does not tolerate fragility for long. Being bullish is not a strategy. Having structure is. Before thinking about targets or timelines, you need to know what role you're playing. Are you trading short-term movement or holding long-term exposure? Those are different games with different rules. Traders focus on survival first. They assume price can move against them fast. They size positions accordingly. They decide exits before entries. Long-term holders accept volatility as part of the process, but only if their position doesn't force emotional decisions during stress. Most people fail because they mix these roles. They enter with long-term logic and manage with short-term fear. Or they trade aggressively and tell themselves a long-term story when things go wrong. That mismatch is where losses compound. Liquidity and leverage are the mechanics that do the damage. In calm environments, liquidity feels invisible. Under stress, it disappears. Price jumps instead of drifting. Silver feels this immediately. Leverage works quietly until rules change. Margin requirements rise. Financing tightens. Positions that felt safe suddenly aren't. If you don't have flexibility, you lose control. This is how people get forced out during pullbacks that don't break the bigger trend. Signals matter too. Price tells you what happened. It doesn't tell you what's building underneath. Urgency shows up when buyers prioritize immediate access. Tightness shows up when sourcing becomes expensive. Divergences across regions show uneven clearing. These don't predict tops or bottoms. They tell you whether the move is supported or fragile. Psychology decides outcomes. Fast markets compress time. People feel urgency. They chase strength and panic on weakness. The market feeds on that behavior. The participants who do well aren't smarter. They're calmer. They're not forced. That lack of pressure is their advantage. Silver is responding to more than supply and demand. It's responding to confidence shifts, currency stress, and policy uncertainty. Those forces don't resolve overnight. The path forward won't be smooth. There will be rallies. There will be pullbacks. There will be tests. That's normal. What matters is whether you've already decided how you respond. Not in the moment, before the moment arrives. If you're trading, respect size and risk. If you're holding, accept volatility without rewriting your thesis. If you're waiting, make that choice intentionally. The biggest mistake people make is outsourcing their thinking to the crowd. The crowd reacts. The crowd is emotional. The crowd is late. Markets reward clarity. Silver isn't important because it moved fast. It's important because it's revealing stress. Stress works through systems over time. Assets tied to confidence and utility feel it first and hardest. Your job isn't to predict every move. Your job is to avoid being right and still losing money, because your structure couldn't handle the process. Stay calm. Stay deliberate. Stay unforced.